Hello, I'm Charles Boettcher, Managing Director and Senior Portfolio Manager at City National Rockdale. Welcome to Market Perspectives. Markets are experiencing more volatility in November relative to the October melt-up, which marked an all-time closing high of 68.91 on the S&P 500 on October 28th. Anticipation of an end to the government shutdown, which has now happened, helped boost the U.S. market back above 6,800. The Magnificent Seven stocks gained 17.6% during the third quarter, and corporate capital expenditure in AI infrastructure continued at record levels. Growth stocks, particularly those with ties to AI, continue to outperform their value stock peers, as the Russell 1000 Growth Index has outpaced the Russell 1000 Value Index. The information technology and communication services sectors led quarterly gains, while consumer staples faced pressure and healthcare struggled to keep up with its growth peers. With a little more than a month ago, the S&P 500 return is sitting around 11-12% year to date. Absent any material volatility before year-end, it's possible that the S&P 500 produces double-digit returns for the third year in a row. That prospect surely has U.S. equity investors giving thanks. Always worthwhile to check in on earnings and margins, as they are very important. Corporate profits for the year continue to exceed forecasts, and corporate margins remain high. Let's dive a little deeper on each. Third quarter S&P 500 earnings are tracking at 14.3% growth, marking the ninth consecutive quarter of growth. You can see the quarterly trend and history in the left-hand chart. The results over the past 8 quarters partially explain why U.S. stocks have had such a rewarding run. Shifting to the right-hand chart, the earnings per share beat rate stands at 82%, indicating a strong performance by companies in exceeding earnings expectations. Notably, analysts increased their estimates heading into the quarter, resulting in the first positive revision trend since late 2021. Margins have proven resilient despite tariff headwinds. Margin expansion is increasingly concentrated in mega-cap technology companies. It's well noted that a handful of mega-cap technology and AI-driven firms now account for a record share of index returns. The last column in the left-hand chart illustrates the top 10 companies contributing to the S&P 500's year-to-date return, and 7 of those are considered part of the Big 10. Shift your eyes to the right to see how the relative weight of the Big 10 has grown. A key takeaway is the elevated concentration. As the narrow leadership grows, the overall index is more vulnerable to volatility caused by disappointing news in these few names. Key risks remain, including policy missteps, margin pressure, geopolitical escalation, fiscal credibility, and labor market friction. Volatility also may be heightened as investors now start to receive and digest economic data they were missing during the shutdown. The near-term outlook is constructive, but investors are navigating a transition marked by slower growth, higher nominal rates, and elevated political risk, requiring discipline and selectivity. It is important that investors focus on earnings quality, balance sheet strength, and sustainable margins rather than speculative growth narratives. Discipline and selectivity are being rewarded over broad risk-taking, with a need to diversify client portfolio equity exposure. In particular, we are strongly considering an allocation back into international markets. More on that next month. Each year at this time, we express our thanks for the relationship we have with you and the opportunity to guide clients and advisors to reach their financial goals. Next month, one last video to close out 2025. Until then, I'm Charles Boettcher with Market Perspectives. Take care.